$830 billion. That is the Federal Reserve's estimated size of one quiet trade sitting underneath the U.S. Treasury market in September 2025. It is not a live number. It covers qualifying large hedge funds, meaning the biggest funds, using regulatory reports called Form PF, and it sits inside the market Americans are taught to call the safest in the world. So why does that market depend on a trade built with borrowed money? This video is for educational and awareness purposes only. It is not financial advice. Start with the foundation. When the U.S. government spends more cash than it collects, it borrows. That borrowing is called government debt. The government creates an IOU that promises repayment plus interest. That IOU is a Treasury security, also called a Treasury bond. People, banks, and investment funds buy these IOUs because the United States is expected to repay them. Safe here means low risk of not being repaid. It does not mean the price never moves or that a buyer is always available. A hedge fund is a private investment pool for wealthy clients and institutions. Some hedge funds do not try to guess whether interest rates will rise. Instead, they search for tiny price gaps between nearly identical things. One of those things is the actual Treasury bond bought today. Traders call it the cash bond. The other is a futures contract. That is an agreement made today to exchange a Treasury bond later at a price set now. At the contract's deadline, the futures price and the deliverable bond price must meet. But before then, they can differ slightly. That tiny gap is called the basis. Asset managers, meaning firms that invest retirement and mutual fund money, often want futures. Futures let them copy how bonds react when interest rates move without spending all their cash on bonds. That strong demand can make futures slightly more expensive than matching Treasury bonds. A hedge fund steps between the two markets. It buys the cheaper bond. At the same time, it sells the more expensive futures contract. If the prices meet as expected, the fund keeps the difference. This also explains why the trade helps. It creates demand for older Treasury bonds, supplies the futures that large investors want, and pools two related prices back together. But the reward is tiny. Federal Reserve research found the annualized edge, meaning the yearly rate, was often around 1/10 to 1/2 of 1% during the cited periods. On $10 million, 1/4 of 1% is only $25,000 a year. That is not enough for the fund. So it makes the position much bigger than its own cash. It does that with a repo, short for repurchase agreement. A repo is basically a secured loan. The fund hands its Treasury bond to a lender as collateral, meaning property promised as protection for the loan. The lender provides nearly all the cash used to buy the bond. The fund later repays the cash plus a small fee and gets the bond back. Much of this financing is renewed frequently, often overnight. The lender may apply a haircut. That does not mean cutting hair. It means lending slightly less than the collateral is worth. With a 2% haircut, a $100 bond supports a $98 loan. But the Office of Financial Research found that 65% of hedge fund Treasury repo had a zero haircut. In those transactions, the loan matched the bond's full value. The futures side also needs only a small deposit, called initial margin. Chicago Fed research says this can be 1 to 3% of the contract value. That can permit leverage of roughly 33 to 1 to 99 to 1 on that futures leg. Leverage means controlling far more money than you actually own. It does not mean every fund always uses the maximum. Here's the whole trade in plain English. Buy a government IOU, borrow almost all its cost, sell a contract linked to that IOU, wait for two prices to meet, keep a tiny gap, repeat at huge scale. The bond is safe from default. The financing structure around it is where the danger lives. Now the central question returns. What happens when the prices do not move together for a while? A clearinghouse, the company standing between futures buyers and sellers, checks losses every day. If volatility rises, meaning prices start jumping around, it may demand more cash. That demand is a margin call. The fund may also face a lender that raises the haircut or refuses to renew its repo. The fund then needs cash immediately. To get it, the fund may sell Treasury bonds and buy back its futures. If many funds do this together, bond prices can fall. A dealer, usually a large bank trading bonds and financing clients, must absorb the selling. but every dealer has limited room on its balance sheet, the record of what it owns and owes. Once that room fills, buying becomes harder. Market liquidity, meaning the ability to sell quickly near a fair price, disappears. Falling prices create more cash demands, which force more selling. That's the loop regulators fear. Something like this mattered in March 2020. During the pandemic panic, investors everywhere rushed to cash. Foreign institutions, mutual funds, and hedge funds all sold treasuries. Dealer capacity was overwhelmed. Basis unwinds likely amplified the dysfunction. Research does not show they caused the entire crisis. The Federal Reserve expanded repo operations, then announced it would buy Treasury securities in whatever amount needed to restore smooth market functioning. It also temporarily changed bank rules to make more balance sheet room. That episode doesn't prove the trade is always harmful. In normal markets, it's useful.
It links futures buyers with Treasury sellers. It supports trading in older bonds. It helps prices stay aligned. By 2026, the basis trade itself was roughly flat or lower, not racing upward. Regulators have still changed the structure. New central clearing deadlines will require more Treasury cash trades by December 2026 and more repo trades by June 2027 to pass through a central risk manager. Large bank leverage rules were also eased in April 2026 to reduce barriers to Treasury trading. These changes may improve resilience. They may also raise the collateral funds must post. The final effect remains debated. But one more layer is still left. From 2014 to 2024, Treasury debt held by the public rose from $10 trillion to $24 trillion, a 139% increase. Over the same period, primary dealers, the main banks handling Treasury trades, saw their balance sheets rise from $3.3 trillion to $4.2 trillion, only 29%. The market grew far faster than the traditional shock absorbers. Leveraged hedge funds filled part of that gap. That is the hidden point. This trade is not merely a side bet feeding on America's safest market. It has become partly load-bearing. It supplies private balance sheet space that the much larger Treasury market now uses every day. Yet some of that space depends on frequently renewed, sometimes overnight borrowing. It belongs to private firms that can pull back during stress. So the same trade can be helpful and fragile at once. On ordinary days, it connects buyers, supports bonds, and keeps prices honest.
On the worst day, its borrowed structure can turn those helpers into forced sellers. The danger is not that Treasury bonds suddenly become worthless. The danger is that the machinery around them may demand cash faster than the market can provide it. Thanks for watching. If you want to see more videos like this, make sure to like this video and subscribe to the channel.